Val, welcome to the podcast, and thanks so much for joining us.
Thanks, Jeff. Happy to be here.
Yeah, I've been excited to have you on because I know we're really pushing into the auto lending space, and I thought it was just an interesting area to explore overall. And we've known you for a long time. You and I met many years ago. I hate to do the math on it. But you were really, before joining Upstart to lead the charge into auto lending, had been involved in the automotive space for quite a while. Can you give me a little bit for the audience of your background in the kind of auto industry in general before coming here to Upstart?
Yeah, absolutely. And it's something like 9 years, Jeff. I've done the math for
Don't
better
do
or
the
for worse.
Closing in on 10, I guess.
Yeah, but we actually met first time when I was working at my first job out of college, which was actually at the retail side of the automotive space. So I worked for a large privately held dealership group in Michigan. And you had come out with Dave to talk about Upstart. You guys had just started it and we're building it out. Mm-hmm. That's when we had met. And I was hired in out of school to work for this dealership group. Basically, back then it was pretty large. It's 13, 14 stores. Now it's like 33, 35 stores, so it's grown. But back then they were trying to sort of consolidate a little bit the management because it was sort of very distributed. And so I was brought in to help do that. And I've done and have had almost every position at the dealership, from selling cars on the floor, because the owner of the company was like, "You're not working for me unless I know you can sell cars." And so I walked in on the first day, fresh graduate, degree in economics from University of Michigan, and he's like, "Go sell cars." My parents were not impressed. I was pretty shocked. I did not know that's what was going to happen, but that's okay. So I did that for a number of years, finally running the East Coast for them, so about 6 dealerships, and then I came out here to California to the SF Bay Area and started a company in the automotive space and worked on that for about 5 years. Raised some money for it. It was automotive marketplace, focused on financing. So I've been in the space for a little while, and it's the bulk of my career.
Interesting. What was it like selling cars? Was that sounds like an interesting, they've got the old saying that everybody should be a waiter for a year because you kind of learn what the services industry is like. My take is everybody ought to have a sales job for a year because you learn so much about human motivations and how to convince people of things and how people interact. What was it like actually being on the floor selling cars? It's hard for me to imagine.
I mean, that's exactly it. So once I got over the shock of it, and really not during the time, but looking back, it was probably the best thing that could have happened, because auto sales is sort of one of the more unique sales positions where you get a lot of reps. You talk to multiple people every day, and when you first start, you screw up a lot. You say dumb things, you say the wrong things, you don't necessarily know your product very well, but you have an opportunity just minutes later to start over again and try again. And so you end up getting a lot of reps, and I think that it probably makes some pretty good salespeople. You learn very quickly, kind of what you mentioned, like how do you relate to people? How do you understand what their problems are? How do you position this vehicle that they're looking to buy in a way that they understand how it's going to help solve their problems, or if they're making an aspirational purchase, how that's going to add value to their lives. All those things that translate really well to all sorts of sales.
Yeah. So what drew you to the auto space? Have you always been a car guy? I mean, what brought you into going into work for a dealership out of college? How did you do that? Make that call?
I mean, I grew up in Metro Detroit, so I didn't have a choice. Everyone
it's in the
was
water.
involved in the auto industry in some way. Yeah, like it's depending on where you go. Everyone was involved in the auto industry in some way. I had uncles and cousins that were working in the auto industry for either manufacturers or suppliers. Certainly, you saw a lot of people that were very into Detroit muscle, and we have a lot of things in Michigan that are tied to automotive history. And so it was sort of a natural pull. I've always been pulled to that as well, and sort of leaned into it. And so when the opportunity came up to go to this dealership where I thought there was a lot of opportunity to learn something very quickly and really get into understanding sort of management very, very quickly, it was almost a no-brainer for me. Wasn't what I expected, but at the time I thought I was making the right choice, and it was the right choice. I learned way more at that role than I think I would have at any sort of more traditional job.
Interesting. Well, so you came to Upstart with the goal of launching an automotive lending business here. We didn't have one when you came. We had aspirations. And I remember the conversation with Dave went something like, let's hire somebody really smart and scrappy that knows the space, and they'll figure out what the heck to do and drag us into it. And that ended up being you. And, Upstart has launched into the automotive space in the refi category, which is not the biggest category of lending. It's actually quite a small piece of the automotive lending space. And I want to get into why that is in a minute. But first, what was it about the refinance space that made that appealing to you as the place Upstart should really use to enter the market?
Yeah, it's a great question. And you're right. I mean, automotive refis, sub 5% of the auto lending space. So it's pretty small. But what's interesting is that, for many, many years, consumer awareness that auto refi was even a thing has been very low. But in the last 3-4 years, it's grown significantly. What's more interesting is that the number of refi loans haven't kept pace with that awareness. And so when you really look at, so when you look at like what's actually going on here, you see that, where refi is offered today, if you go through the process, there's either, a lack of savings or there's a lack of convenience. It's very hard to get a refi loan in most cases, or maybe the rates aren't compelling. And you know what Upstart's really good at? Making things more convenient and using the underwriting to power additional savings. So I thought it was a good way to enter into the market, which is, the auto market's very large, but it's also very nuanced and complex. There's many different iterations within the auto market. And I thought it was a good way to enter it to sort of play to our core competencies as a company.
Makes sense. Stick to what you're good at in terms of how you enter a new space. I was really intrigued by this comment that consumers typically haven't been aware. I mean, I know that obviously mortgage refi is something most people are aware of if you have a mortgage. I think there's a growing awareness of credit card refinancing in the form of personal loans. But why do you think historically consumers haven't been aware of this concept of refinancing an auto loan? And why do you think, you made the comment that it's been shifting and there's more awareness in the last couple of years? What do you think has driven that shift in awareness for consumers from being less aware for whatever reasons into being more aware of this as an option?
Yeah, I'll answer the second question first. The awareness has grown because auto debt has increased. If you look at both the price of cars and how much people are actually borrowing to finance their cars, it's been on a steady climb up, and so it's becoming a bigger portion of sort of wallet share for consumers, and has been over the last basically since 2008 when the market started recovering, and so now consumers are thinking more and more about, how do I save money? How do I increase my sort of monthly cash flow is sort of how consumers tend to think. And so now auto refi is sort of one of those options. And that's one of the reasons why it's become a category where consumers are actually starting to think more about it. It's just that the product offerings haven't kept pace.
That's fascinating. So why do you think that is? You said the product offerings haven't kept pace. It does seem like when I look at most lenders, banks, credit unions, others, they're not really offering this product. And I'm curious why you think that is, because it seems like, most banks get into the mortgage refi space. The idea of refinancing the second largest, loan that typically people get, also a secured loan, the kind of thing banks typically want to do. Why have they not been in that space more actively?
I think there's a couple of factors. So one, it's a bit of a chicken and egg problem. A lot of lenders do have this as sort of a product of convenience, where maybe a borrower will come in and ask for it, and they'll go through the process in doing it. They don't actively market it, partially because they haven't necessarily had success with it in the past, and so it's hard to sort of take that leap and say, I'm going to go all in on this, or really try and focus on this without really knowing if you're going to be successful at it. And I will say that there's a caveat. There are some lenders out there, especially on the credit union side, that really crush this. We're talking about billions of dollars worth of auto refi on an annual basis, and do a really good job. But I think it's a very small portion of them, and it's hard to really get into that space. And the second piece is the actual product piece of it is actually really, really hard. When you refi a loan, you're working not just with the previous lien holder to get that payoff, but you're working with the different DMVs to actually get a new lien released and then placed, and that's all happens on a state by state basis. and it's really, really challenging to manage all of that complexity. And that's one of the things that we think that we can bring to the table and figure out.
In the traditional auto purchase loan, are those things handled at the dealership? What makes that easier in the kinds of loans that banks credit unions are doing at more scale today versus in this refi space? Why is that more challenging here?
Yeah. And to your point, that's exactly it. So for indirect lending, which is the largest category of auto lending today, that happens, with the dealers sort of being the intermediary between the financing partner, the bank or credit union, and then the consumer. And that dealer really has a responsibility to help close those loans. So they're very actively working with DMVs, with the banks to make sure they get the right stipulations, they get the paperwork handled, and all that kind of work done. And it makes it, in some cases, very convenient for the consumer, but a little bit easier for the bank as well. And so that's what happens with the rest of the market.
Interesting. That's not you can't do that in a refi loan. They're not sitting at a dealer, so you gotta handle it all, and maybe handle it all in your case without a visit to a branch, without a physical in-person interaction. In the case of what you're building here.
Yeah, that's right. And I think that's a big piece of it, right? Consumer expectations have really changed in terms of how they want to engage with all of the different companies in their lives, and a big part of that is wanting to be able to do things digitally. I think the sort of threshold of maybe pain or friction that people are willing to take on now for some sort of outcome has been lowered because so many things have gotten so much easier, right? You look at something like, you want food at your door? Great, go to DoorDash. You want to watch something? Great, go to Netflix or Amazon Prime or Apple TV or 6 other things. It's just gotten way easier, and the expectation is that, wait, why can't I do this for my auto loan as well? I want to do this digitally.
So you talked a little bit about what the challenges in building this product. I don't know if you wanted to kind of enumerate what you think it really takes to be effective in the refi space, like what you really have to build and be good at in order to be able to build. I guess my sense is most lenders could do this, but the challenge would be being profitable, being able to effectively re-underwrite at lower rates enough consumers. Like having it be a successful, growing, large, profitable, product line are two different things. What are the key elements you think have to be there to make, the large, growing, profitable part of that business true versus the product of convenience that's there in the branch if they ask for it, but not really something that you're using to grow a substantial portfolio?
Yeah, this is a great question, and this is the crux of the challenge and how we're thinking about building the product. I mean, the first thing is the underwriting, right? You have to be able to underwrite accurately so you know which of the borrowers, maybe they're current customers of yours, or maybe you're going out and trying to find new customers. Which of those customers or borrowers actually are good credit risks and should get a lower rate. And you have to give them a good rate. You have to make that offer compelling to them so that they even engage there. For refi, unlike something maybe like a credit card refinance, someone is already paying for that vehicle. They already have that payment into their monthly cash flow. And so there maybe isn't as much of a sense of urgency as with something like credit card where that payment is just increasing as they're adding more to their credit card debt to refi. So you have to make a really, really compelling offer. But then the second piece is really tied to the convenience aspect and providing internally. You have to have operational efficiency to be able to do this in a way where it's both very, very easy for the consumer, the borrower, but also for yourselves streamlined in such a way that you can actually be profitable with it. Because there are hard costs associated with the underwriting. Yeah. There's DMV fees, there's registration fees, there's other things that sort of go into it. And so that operational efficiency is really, really critical. And if it's something that you don't necessarily do today, it's hard to build that operational efficiency for refi. That's going back to one of your earlier questions. Why isn't this bigger, and why don't banks, credit unions get into it more aggressively? You have to build out a whole different sort of competency. And then the last piece is marketing and targeting. How can you really intelligently find which borrowers out there, especially if they're not your current customers, you can actually market to so that you can give them those better rates and
Yeah.
actually close them with that operational efficiency. And that's really where it comes in, and that's our view of how to make this really, really compelling.
Yeah, it's kind of three big things, I guess. Targeting the right people, being able to make them a compelling offer, and then being able to close it quickly and easily without incurring too much expense internally. Now,
Exactly right.
when you build that at Upstart, and I should highlight it, for our bank partners. So this is like a product offering we have for banks and credit unions. So not just, an Upstart internal thing, but one of the things that's interesting to me is you kind of started with a foundation from personal loans, right? So there was a large personal loan infrastructure to do the unsecured loan. And I'm curious how much of that is transferable, how much, obviously there's no like transferring of a lien and a title in the concept of a personal loan. Yeah. But there's risk underwriting. It's not exactly the same, but it's similar. How much did you borrow? How did you think about where you start fresh, where you build upon, Upstart's history, and how much you could borrow from the existing infrastructure to build out this new product area?
Yeah, this is a great question, and sort of like starting at the top, the philosophy of how we want to build the product between personal loans and auto is the same. I probably sound like a broken record, but it's really about that convenience with the underwriting. And so that's the lens that we look through. But when we actually start to build the product, we start to see differences, right? There's a massive difference between personal loans and auto, because with auto being a secured loan, you have the asset, you have the lien, you have to actually close that, and not just that, but you have to do things like verify insurance. And so when we make this process and understand, we want to make it super frictionless for borrowers, we want to have that same instant concept that we have in personal loans today. We want someone to come in to the website, apply, and get to signing a promissory note, an agreement to get funding, all within one session without having to provide any additional information. That is how we want to do it, but it's much harder in auto than it wasn't in personal loans. And so we have to, it's not actually necessarily much harder. We just have to think about it differently, because there's different things we have to verify and understand. And so, basically what we did is we took our instant model and we applied the pieces that were most applicable to auto, and now we're building on top of that to modify it in a way that really fits to auto, because certain risk factors are not really important in auto, but there's other risk factors that are new for auto. And so we're trying to take as much as we can without taking it wholesale, because it just doesn't translate quite that well. And then the consumer behavior is a little bit different as well. And so that translates to something like marketing, right? I kind of mentioned it as one of the three pillars of building out this successful program. Even the way that we have to look at borrowers and how we market to them is different from personal loans, because now they have something to compare to. They know that they have a certain loan payment in front of them.
Yeah,
exactly. And so that's what we have to really focus on.
Let me ask you one other thing. There's this interesting question, I think, in the tech world, but as it applies to financial services products, is a bit different, which is how early do you launch? Kind of the question of never let the perfect be the enemy of the good, right? Like, how do you think about, you want to get to levels of instant that we have in personal, but like, we probably don't have that today, I'm going to guess. And how do you think about when the product is close enough, and how valuable it is to be in market and learning from actual experience and launching for that purpose? And then how you think about when the product scales, or just, I think that whole question of when do I launch, how much do I expect, how do I grow and learn from being in market versus designing in a vacuum is a really interesting one. And I'd love for you to talk about that a little bit, because I think you guys have done an interesting approach and pretty effective at doing that. So I just wanted to kind of touch on that a little bit.
This is a great one, because this is a in my mind, it's a risk question. And this is an area where we have to partner very, very closely with our legal and compliance teams to help them understand what it is we're trying to do, what it is we're trying to learn, and so that they can give us feedback on what risk is present here, if any. And so, when we thought about launching, in general, my mentality is launch as quickly as possible, because when you're building in a vacuum, you're not getting that real world feedback of, what do consumers actually care about. You think you understand the consumer behavior. We've learned a lot since we launched about how different auto consumers are from personal loans. And so those sort of categories of learning are are absolutely critical. You can't do that, while taking sort of undue risk. And so for us, when we initially launched this, we actually launched this in one state. We actually launched it under our own license because that way it was Upstart that was taking on the initial risk of the process as we were figuring things out. We weren't extending it out to our bank partners. And then we didn't launch to bank partners until about 6 months later, once we worked out the kinks, understood what the challenges were, and felt really confident that we had a real product that had some level of maturity that mitigated the risk that the bank partners really care about. And that came through the partnership with our legal and compliance teams, and then even some of our bank partners that were really open with us about what it is that they're looking for, helping us understand what areas of risk that they wanted to make sure we really covered as we got this to start scaling.
Yeah. The other part of your approach that I thought was really fascinating was the question of, particularly in the operational efficiency, the marketing targeting, that kind of like, can I be profitable in this space? And how do you, the idea of going out at a smaller scale and then growing as you reach a point where those things have matured and your ability to kind of turn the crank and then say, hey, we're at a point where we can actually kind of turn up the dial now because the execution level is higher. Talk a little bit about how you thought about that, because I think that was a really interesting approach. I think so many, particularly lenders I see, but there's a kind of, the product goes out the door and then it is what it is, and not as much of a focus on particularly the efficiency of a funnel, which for a product like this can be the difference between losing $100 a loan and making $300 a loan. And one of those is good and one is bad. So talk about what were you seeing when you first went out the door, and then how do you think about when it's time to actually turn up the crank and what the delta is between the two?
Yeah, that's a really great question, and I think that the mentality we had through all of this, and I credit this to Upstart's culture, is that we think of almost everything as being iterative. There's no final form. And so, when we launched this, either on our own licenses in Florida or start expanding out to bank partners, the mentality has always been, we want to get to market, but we know that a lot of that is going to be actual learnings that we'll end up pulling in. And, it's not just like we're going to put the product out, see if it wins or doesn't win. We're going to go out there and try and figure out where it's winning, do that a little bit better, figure out where it's losing, put a lot of resources there to make sure that we start winning there. So that's really how we started doing this. I mean, when we started with the auto program, the conversions were certainly not where we expected it to be. A large part because there were areas within the product and the flow and the funnel that had friction we didn't initially expect. Right. This was the sort of the issue you mentioned of working in a vacuum. So it wasn't until we started having borrowers come through and getting feedback from them on, hey, you wanted me to do these three things. I dropped off at number 3 because it was the question was too hard to answer. There was something else going on. Great. We have to go back to the drawing board and say, is there a way that we can figure out number 3 with less friction on the borrower side? And so going through that over time is sort of really critical, and it goes back to the learnings that we had from the personal loan program. We know that friction is really challenging for consumers, and so we want to take a lot of those same concepts like instant. But when we started in the auto program, the instant approval rate was almost 0. Now it's closer to 50-60%. And so we've made that sort of iterative improvement over time as we learned what things we can actually make better.
I think that concept of learning and the magnitude there is really interesting, because you're not talking about a 5% delta or a 10% delta. You're really talking about the change in efficiency of the program that goes from money losing to money making, and understanding how to get out and market and be willing to lose a little bit maybe in the early days to get the learnings, but the knowledge that you, with the right iteration, can get there. It's just a different mentality than I think many traditional institutions take to product development. And it's, I think, critical to actually building something like this. So I wanted to kind of highlight that.
To your point, we're talking about like order of magnitude difference between when we started to where we are now. That's because we knew that when we started, our expectations have always been really high of where this program can go, and they still are. But we knew that we wouldn't start there, and it was going to be a process, and it's still going to be a process.
Yeah, and the other part I always think about when I think about lenders is, you talked earlier about kind of consumer awareness, and I actually think many lending products are traditionally pull products. they're products that a consumer asks for. I'm buying a car, I need a loan. I'm buying a house, I need a loan. And refi products are often push products, which means there's actual like marketing dollars going out the door to drive this. And in the case where you're actively soliciting and therefore spending marketing dollars, the conversion funnel matters so much more, because you actually like you're spending dollars not on a per borrower basis, but writ large. And then you've got to convert those dollars into enough loans to be profitable. And so I think that really for these kind of push products where you're kind of actively soliciting borrowers who didn't come to you asking for the product, the need to get that funnel right to be profitable is really high. And it's probably one of the reasons that those more push type products have not been as adopted by, banks and credit unions, because it's like you have to have the funnel right. Whereas if you're a mortgage and somebody walks in the door, like your funnel efficiency limits your growth, but it doesn't hurt your economics in the same way that it does when you're spending millions of dollars to send direct mail or run digital advertising or something that you have to recoup in terms of your cost.
That's exactly right. Absolutely.
Well, Val, we talked a lot about refi, but I'd be remiss not to ask about the other larger portion of the automotive lending space, which is, people buying cars mostly at dealerships, although obviously there's also person to person. What do you see happening there? I mean, most lenders that are in the purchase space are there through the indirect, through a handful of kind of distribution partners in dealership offers. Are there, I know like the way I buy everything has changed in the last 10 years. So I'm curious what you see coming in terms of e-commerce or different ways consumers are actually going about the purchase decision, and what thoughts you have around how lenders need to be thinking about being there in the future ways people are going to be buying cars, and how we can improve, the lending experience in the context of new ways to purchase.
Yeah. Within auto for the last 15 years, everyone's been talking about sort of the e-commerceification of auto. And
is that a word?
For
E-commerceification? I like it.
If it isn't, I made it up. Yeah.
You printed it right now. Put it in the OED.
Yeah. And everyone has sort of expected this to happen, and it didn't happen. It didn't happen. And then all of a sudden it did happen. And it happened with, the players like the Carvanas and the Vrooms of the world, where, you look at the biggest independent retailer, which is CarMax. They own, I don't know, somewhere in the order of 8 or 9% of the auto market, and the auto market is very fragmented. So that's a large percentage. Carvana, since they launched to now, they're up to 2.5 to 3%, and so they're pushing really hard into making e-commerce a really critical point of engagement with buyers, to the point where CarMax is now reacting. They just invested $200+ million in creating a e-commerce platform to sell their vehicles as well, so to compete with Carvana. And so consumers are more aware of this, and they are more used to buying things online, bigger purchases online, cars, which is one of these things. And so that is a trend that has finally caught up with what people expected the future to be, and it's moving quickly. And for better or for worse, things like COVID, really pushed that forward even more. And so a big part of that e-commerce process is actually getting that loan. And so being able to provide consumers, dealers and consumers, and the final consumers, a loan online with different vehicles, different deal structures, to enable them to make an informed financial decision is the key, and is part of the future that we're seeing being built, and we're building into that future. That's part of why we acquired Prodigy, which is dealer software, digital retail software. Dealers now understand this, and they know that they have to compete with the Carvanas. They have to compete with the CarMaxes that are going more, they call it omni-channel and more digital. And so, software like Prodigy is going to support that, and we're going to help, build some of that support as well on the lending side, to make sure that our bank partners are part of that transition, part of that process, so that they don't miss out and get locked out of that very large part of the market.
Yeah, large and growing, I think, as we all look at the consumer trends. The other thing that surprised me, and I wanted to get your take on, was the challenges, even in the current world of, I thought of like auto dealer to lenders through, I mean, as a consumer, I hadn't no clue what the pipes were and how it worked. but that there's really, an opportunity to increase the flexibility dealers have to look at, to your point, multiple cars, multiple deal structures. That's like, I never really fully understood the pain points around the inflexibility of many of the systems that are utilized today for that. So I wanted you to talk about that, because I feel like that's an area of consumer preference that's absent the even e-commerce versus walking into a dealer decision, that is kind of a place technology can improve the way lending is integrated into the car purchasing experience, because it is so often hard to look at different down payment amounts or different add-ons at the end or different vehicles and have a good sense of the pricing because of the way it works.
Yeah, that's a great question, and I think a lot of that is there's actually, I think, maybe more complexity than a lot of people think about that happens at the dealer as they're trying to work with both, the bank and what's available there, and the consumer, the one that's actually buying the car, and what it is that they want, while also making sure that they have sort of a place in that deal. Because for the dealer themselves, they're the conduit between these two players, they have a lot of that control, and they need to make sure they provide value to both sides while still getting a little bit of value themselves. And so it's actually a very complex optimization problem, because to your point, there are many different factors, from things like trade-in value, and if that's positive equity or negative equity, how much down payment, what sort of products the borrower or the consumer might want, and then profitability for everyone involved, for the bank and for the dealer, and that's a very, very complex problem. And the structures today, the pipes and the rails that are currently out there, weren't really built to support that. Certainly not within an e-commerce paradigm or e-commerce context. And that's where a lot of the change is happening, because frankly, the consumers that are coming in, they're much more educated. And so they have a much better sense of the different levers that are being pulled, and they want to engage with the dealer on those different factors. And the dealer has to have the flexibility to move things around. And that's just not available today. That's part of what we're trying to build.
That's really interesting. So let's just summarize for me. If you look out over the next 3-5 years, what are the big opportunities that lenders who are looking at the automotive space ought to have their eyes on, that you think are really the places to be investing?
Yeah, a great question. I fundamentally believe that we're going to see, and we're part of pushing this, the catch up between the awareness of automotive refi. People are trying to save more money, and then the size of the market that auto refi is. That it's been lagging, it's going to catch up, and we're building the product to make sure that does happen. So we expect to be really big winners as part of this, and hopefully our bank partners as well. The second one is what we just talked about, the e-commerce aspect of it. Auto sales is going more digital, and being part of that is going to be absolutely critical to make sure that you don't get locked out. And that is being powered by the technology, and being able to have that flexibility and be able to provide different types of offer is going to be absolutely critical. And so those two things right there we think are going to be very, very large. And then the last piece is actually really tied to dealers. Dealer margins on the sales historically have been getting more and more squeezed. And so, things like back-end products are going to be increasingly important for them. And consumers are more educated about what those back-end products are, the vehicle service contracts, the gap insurance and such. And so being able to offer real value for those products is going to be critical, both for the dealer to continue selling them, but also for the consumer that's buying those and sort of is able to research those at a higher level.
It's great advice on things to be watching for. All right, Val, we've come to the end of the interview here, where I like to do a little lightning round of 3 quick questions, but I have modified them for you because, we got an area of expertise here that I wanted to dig into. But let me start with one of my standard questions, which is, what's the best career advice you've ever gotten?
Best career advice? Probably take more risk in your career. Take more career risk. Think twice before jumping to maybe the more traditional career path, and maybe the career path that is a little bit less traditional. In many cases, there's just a larger upside there. don't be silly about it, but definitely think twice before taking sort of the traditional path.
I like that. I've taken several alternative paths in my career, and every time I think they felt riskier in advance and they felt it in the moment of actually doing it. And that was a really interesting insight to go, hey, yeah, like that seemed really risky. And then after the fact, I go, hey, that wasn't that risky. Those risks are where a lot of the best opportunities lie. I like that. Be willing to take some risks. All right. What's your best car advice? You're a car guy. I'm not a car guy, so I need some car advice. What's your best car advice you've ever gotten?
I mean, in terms of, let's say, making a purchase on a vehicle, I'll say like buy pre-owned all day, every day. That's like value for money. That's where you're going to probably get the most value. 2 or 3 years old is where it's at. Especially
2 or 3 years old.
Okay. Yeah, because like the car is still in perfect condition, still under manufacturer's warranty. It might even be certified pre-owned, but the initial depreciation of the vehicle has already happened. There's a big depreciation. The depreciation curve on a car, there's a big 20% drop as soon as you drive a new car off the lot, and then it starts to sort of flatten out a little bit. You want to get it after that drop's already happened.
All right, so grab somebody who's driving off the lot and buy the car off them for 20% less than they just paid. I got it, 20%.
Yeah,
right
just
there.
just follow them home and give an offer.
Just follow them home, and here I got an offer for you. All right, what is your all-time? Yeah, it might be a little creepy. It's just the dealer going to come to you standing there outside the dealership lot, following people home. What is your all-time favorite car? This is a hard one for a car guy, but what's your?
It's easy for me.
Okay.
Classic, and maybe a bit of a cheat, but the McLaren F1 LM, older car. It was for a decade the fastest car that a consumer could buy, which is today, like every year you hear like a new faster car. The F1 LM was just absolutely incredible. The attention to detail on that vehicle was insane. The engine was encased in gold foil because it helped with the heat dissipation. It was like just absolutely
the coolness
classic,
factor too. I think.
Car.
Do you think the gold foil was
massive.
about the cool and the look, or do you think it was about the heat dissipation? It feels like it's a little bit of both there.
Yeah, it was a 3-seater because it was race style. So the driver would sit in the middle, and then there was 2 seats behind him or her. So it was just like such a cool car.
Have you driven such a car?
Man, I wish.
All right, add it to your bucket
too many
list.
Of them have
Driving
been wrecked, unfortunately.
I'm sure many of them have at the speed those things drive. And then my last question: what's a bold prediction you have for the future? It can be auto, can be lending, can be random, whatever you want. But I want something to hold your feet to the fire about when I bring you back.
Oh man, this one is probably the harder one.
For sure, particularly because I can play this back to you in a year and see if you were right.
Yeah. Well, there's one, but I actually don't know if I can say this at this because it's about Upstart, and I don't know if like as a public company if I would get in trouble.
I wouldn't mess with that as a public company. You don't want to get in trouble with the lawyers and the compliance team you spent so much time building a good relationship with.
I know. They'll get really mad at me about that. This is the toughest one. I haven't put a lot of thought into this.
I know. I have to save the hardest for last.
So I would say that within I'll sort of make an industry projection. Perfect. I would say that within 5 years, over 35% of auto sales will be all digital.
5 years, 35% of auto sales. That's a great prediction. I'll tell you, Val, you did better than Paul, who did not see this question in the pre-read list and did not come up with an on-the-fly answer. So I like your on-the-fly coming up with a bold prediction. I think the industry is perfect. So thanks a lot. This was a fun conversation. I'm glad we could find the time to make it happen, and I appreciate you joining us for this.
Likewise, Jeff. Honored to be on here to talk to you. Very happy to have been part of it.
All right. Thanks.